Hi everyone, good to see you again all. I hope you all will be fine. Please subscribe my channel for more latest updates. 10 best investments for 2023. It's a smart move to diversify your portfolio with a variety of stocks, bonds and other investments. What are the best investments for the rest of 2023? Though it may initially seem underwhelming, the answer is, it depends. Every investor has different goals. Young adults may want to accumulate savings with the eventual goal of owning a house, while those further along in life may be saving for their kids' college and their own retirement. Investors who are older still, or already in retirement, may have capital preservation as a primary goal, with growth being a secondary concern. These days, high interest rates and inflation are putting a dent in many investors' plans, so a fresh look at allocations may be in order. Given the current backdrop where the Dow Jones is lingering at record highs and seems primed for a correction, I'm particularly watchful, says Jeff Rose, a certified financial planner and founder of goodfinancialsense.com. The looming shadow of inflation is undeniable, and even though unemployment figures appear steady, there's an underlying fragility influenced by the broader economic and political climate, he adds. With that backdrop, here's a look at investments to consider for the rest of the year. As with any investment, base your decisions on your unique financial situation, which includes your goals, time horizon and risk tolerance. 1. Growth stock funds. As the name suggests, growth stock funds focus on companies with strong potential for above-average earnings increases, along with capital appreciation. However, risks of high volatility, overvaluation and susceptibility to market corrections are among the downsides of growth stocks, which don't perform well in every market cycle. Growth is back in vogue, says Sean Castelline, wealth manager at Delta Capital Management in Orlando, Florida. He adds that growth stocks as a whole performed poorly last year because interest rates were skyrocketing. Growth companies use debt to expand. So, having a predictable interest rate makes the growth space a lot more attractive, says Castelline. As the Federal Reserve's cycle of rate increases tapers off, growth is likely to become more attractive. Growth stock funds to buy now. Less than speak greater than Castelline says growth stock exchange-traded funds, or ETFs, that investors may consider include iShares S&P 500 Growth ETF ticker, IVW and Technology Select Sector SPDR Fund, XLK, less than, speak greater than. 2. Value stock funds. A value stock fund seeks out stocks trading below their intrinsic worth, aiming for long-term capital appreciation as these stocks eventually appreciate in value. Those stocks are profitable companies whose prices are beaten down because the entire industry is out of favor. Those are frequently value stocks. Research has shown that over time, value stocks tend to outperform growth. In the past decade, growth stocks have performed better during most rolling timeframes. However, many financial advisors recommend owning value stocks, as they often perform better than growth during bouts of high inflation. In an overvalued market, value stocks can offer a safer haven, says Rose. They tend to be more resilient during pullbacks and can provide long-term appreciation. Value stock funds to buy now. Rose suggests looking at value funds, including Vanguard Value ETF VTV, iShares Russell 1000 Value ETF IWD, and Schwab US Large Cap Value ETF SCHV, which could offer stability during a market downturn. 3. Dividend stock funds. Dividends are a vital part of overall portfolio return, particularly for investors seeking income. According to a May 2023 report from brokerage Fidelity, dividends have accounted for 40% of stock market returns since 1930. That number rises to 54% during decades when inflation was high. In uncertain times, dividend-paying stocks can provide a steady income stream, says Rose. He advises investors to focus on companies with a solid history of dividend payouts. Dividend stock funds to buy now. One fund Rose likes, Vanguard Dividend Appreciation ETF (VIG), tracks companies with a consistent track record of growing their dividends. That can provide some income stability during times of market uncertainty. Rose also suggests taking a look at iShares Select Dividend ETF (DVY), which prioritizes high-yielding stocks, and Schwab US Dividend Equity ETF (SCHD), which offers a mix of dividend income and potential for capital appreciation, to balance growth and income. Castelline adds that dividends offer investors more consistency as they pay regular income, which can shore up portfolios in periods of volatility. One of the funds we like in this space is the iShares Core Dividend Growth ETF (DGRO), he says. It pays a healthy dividend but also focuses on companies that are raising their dividend on a consistent basis. 4. Index funds. An index fund is a passive investment vehicle that simply aims to replicate the performance of a specific market index. Index fund investing is popular, as it provides built-in diversification, and it typically carries a low expense ratio since the fund doesn't have to pay a team of managers and analysts. Less than speak greater than the biggest index ETFs are those that track the S&P 500 and the Nasdaq 100, although you'll find index funds representing many broad markets around the world. Less than speak greater than. Index funds frequently outperform actively managed funds, often because of their low-cost structures. But investing in index funds doesn't mean you can just set and forget. You still need to monitor the performance of your holdings and rebalance on occasion, taking profits if one index outperforms and putting them into one that's underperforming. For example, if you've set your U.S. large cap allocation at 20%, and those stocks have risen to account for 30% of portfolio value, you can sell shares and put the money into another regional index that has underperformed. At this time, says Rose, broad market exposure is still essential, but caution is advised given the high valuations. Dollar cost averaging can help mitigate entry point risks. Index funds to buy now. Less than speak greater than Rose suggests considering SPDR S&P 500 ETF Trust SPY or Vanguard S&P 500 ETF VOO, both of which represent the broader market and allow for diversified exposure even during potential pullbacks. Less than speak greater than. He also likes Invesco QQQ Trust QQQ, which tracks the Nasdaq 100. Offering exposure to tech giants that might still have room to run this year, despite broader market concerns. 5. Long-term bond funds. Bonds with a maturity date of 10 years or more are generally classified as long-term. As with any investment, these have pros and cons. Bonds, as an asset class, return less than stocks, but are less volatile, meaning they can help smooth returns when equity markets are turbulent. Long-term bonds typically provide a stable source of income, making them attractive to income-oriented investors, particularly retirees. When compared to shorter-term bonds, they often provide higher yields and potentially better returns. They can act as a hedge against inflation, as their interest payments remain relatively constant over time, potentially maintaining the fund owner's purchasing power. However, long-term bonds are highly sensitive to changes in interest rates. When rates rise, bond prices fall, leading to potential capital losses for investors. Long-term bond funds to buy now. Among the largest long-term bond funds is Vanguard Long-Term Treasury Index ETF VGLT, with a duration of 15.8 years. Another long-term Treasury Index ETF is SPDR Portfolio Long-Term Treasury ETF SPTL, with a duration of 15.8 years. On the corporate bond side, Vanguard Long-Term Corporate Bond ETF VCLT tracks an index of investment-grade corporates. Its duration is 13.1 years. 6. Short-term bond funds. Short-term bonds have relatively brief maturity periods, typically ranging from a few months to a few years. Short-term bond funds come with their own set of advantages and disadvantages, making them suitable for some investors and less so for others. For example, bonds with shorter maturities carry lower interest rate risk, making them less sensitive to rate fluctuations. This can help preserve capital in a rising rate environment. For that reason, they can play a role in portfolios designed to achieve near-term financial goals. These bond funds can provide stability to a portfolio, especially in turbulent markets, and they can generally help mitigate equity market downturns. On the other hand, their lower yields compared with longer duration bonds mean they provide less income. The shorter maturities may not keep up with inflation, potentially eroding purchasing power over time. For that reason, investors could potentially miss out on capital gains, as short-term bonds may not benefit from rising interest rates to the extent that longer-term bonds do. Short-term bond funds to buy now. Vanguard Short-Term Bond ETF BSV tracks an index with a duration of 2.6 years. Schwab 1 to 5 year Corporate Bond ETF SCHJ has a duration of 2.7 years, and SPDR Portfolio Short-Term Corporate Bond ETF SPSB has a duration of 1.83 years. 7. High-yield savings accounts. Sometimes you just don't want to take any market risk with a particular bucket of money. For example, if you are saving for a down payment on a house in the not-so-distant future, you don't want to see stocks or bonds decline while your nest egg is invested. Enter the high-yield savings account. These vehicles can be an excellent choice for people looking to earn competitive interest on their savings while maintaining safety and accessibility. As the name implies, these accounts offer higher interest rates compared with traditional savings accounts. This means your money grows faster, helping you achieve your financial goals more quickly. High-yield savings accounts are typically offered by banks and are insured by the Federal Deposit Insurance Corp. or FDIC, up to $250,000, ensuring the safety of your deposits. Unlike investments in the stock market or other assets, high-yield savings accounts carry no risk of losing your principal. Some high-yield accounts come with additional features like ATM access, mobile banking apps and check writing capabilities. High-yield savings accounts to open now. Banks with the highest yielding accounts include Western Alliance Bank, with an annual percentage yield of 5.2% and a minimum deposit of $1. Raisin offers a 5.25% APY on this account and several others, with a minimum balance of $1. 8. Certificates of deposit. If you have some money that you'll need at some future point, but don't want to put it at market risk, a short-term certificate of deposit could be the ticket. Certificates of deposits, more commonly known as CDs, require the account owner to keep money parked for a specific time period. An early withdrawal would result in a penalty. They are typically offered by reputable banks and are FDIC insured up to $250,000. CDs come in various durations, typically ranging from a few months to a year or two. This flexibility allows you to align your investments with your short-term financial goals. You'll get a higher rate if you leave your money in a CD for a longer period. How to buy CDs. Use a laddering strategy to stagger the maturities of multiple CDs. This provides access to funds at regular intervals while simultaneously taking advantage of higher rates. You can find numerous banks offering CDs with rates higher than 5% for 12-month CDs, but you can also shop for rates for CDs for shorter periods. 9. Commodities and alternatives. Investors who want assets that zig when the broad equity market zags may consider alternatives like commodities. In financial parlance, an asset that doesn't always move in the same direction as stocks has what's called a low correlation. When stocks and bonds perform poorly, commodities can provide a counterbalance, helping to stabilize the overall portfolio. By including commodities, investors can spread risk across different sectors of the economy, which reduces overall portfolio risk. In addition, many commodities, such as gold, silver and agricultural products, have historically acted as effective hedges against inflation. Commodities ETFs to buy now. One of the largest commodities ETFs is the ABRDN Bloomberg All Commodity Longer Dated Strategy K1 Free ETF BCD, which tracks an index of contracts linked to a broad basket of commodities, including gold, natural gas, soybeans, silver, copper, corn and cattle. You can also find more focused funds, such as SPDR Gold Shares ETF GLD, and other ETFs that hold one asset class. 10. Real Estate Investment Trusts REITs. Real estate investment trusts, or REITs, are known for providing consistent and often high dividend yields, making them attractive to income-seeking investors. They are required by law to distribute at least 90% of their taxable income to shareholders. Many REIT investors appreciate the diversification that REITs allow, given the exposure to real estate assets without the need to purchase physical properties. In other words, you can own real estate without worrying about a leaky roof or 3 a.m. plumbing problems. Like any investment, there are pros and cons. Real estate can be a hedge against inflation, but interest rate hikes can impact REIT valuations, says Rose. Diversification across real estate sectors is crucial. Rose is referring to the ability to choose REITs that consist of various real estate asset classes, such as offices, cell phone towers, medical properties and apartment buildings. Like stocks, REITs can be subject to market volatility. Economic downturns can affect property values and rental income, impacting REIT performance. For example, mall and shopping center REITs have done poorly since early 2022. Established REITs to buy. Prologis Inc. PLD, which develops and owns warehouse and industrial properties, and American Tower Corp. AMT, which owns and operates cell towers, are among the largest publicly traded REITs. Thanks, take care.